Investor with Julia Lee.
Welcome to the program. I'm Julia Lee from Bell Direct. On tonight's show, we'll focus on the financials as the Royal Commission turns its attention to the insurance space. Plus, we'll take your questions on Estia as well as Nick Scali. And in our stock in a minute, Gaurav Sodhi tells us his buy in the financial services space. And my guests tonight, Michael Gable from Fairmont Equities and Michael Wayne from Medallion Financial. Don't forget you can also reach us at eq@skynews.com or hashtag equityinvestor. But let's kick off the show with a spotlight on financials. First of all, performance has been remarkably different in the different subsectors in the financial space. The best subsector has been insurance in the past year, up by 9%, followed by diversified financials, up by 7.5%. And then on the other side of the spectrum, the worst, banks down 8.4%. But the best stock in the financial sector has been Macquarie Group, up 43% over the past year, and CYBG up 27% over the past year. Having a look at the worst performers though, and Eclipse Group down 35%, AMP not far behind with a fall of 34%. So what's important when analysing companies in this sector? Well, I'm sure my panellists will agree this is a hard sector to analyse because of the variety of companies that are in it, and also typically the level of gearings when you're looking at things like banking stocks. So, Michael, we'll start off with you. What do you think about analysing companies in this space? What is it in particular that you look for to differentiate the star performers from the dogs?
Well, it really does depend on the business and what subsector it sits in. I mean, insurance companies are notoriously difficult to analyse. For a number of reasons. They've got investment returns, they've also got exposures to different geographical areas, underwriting certain things as well. Banks, often you look at things like book value, and that's again very different to how you would evaluate or value a managed fund or a funds management business such as Magellan or Henderson Group or Challenger for that matter. So it really does depend on the business because some, such as your fund managers, you value more as a traditional business, whereas others are a bit more complicated. You look for stock-specific or company-specific things. Okay,
so Michael, to put you on the spot a little bit, looking back in history, what's been your best investment in the financial sector and why?
Probably Magellan Financial, MFG. That's been a fund manager. We tend to like fund managers because they're simpler business models. They're very scalable in that as you get more and more funds under management, your costs remain relatively flat. But your funds under management fees go up, your management fees, your admin fees even, performance fees as well. So that's probably the best we've done out of any fund manager or any financials business, and that's looking back over, say, a 4 or 5 year period.
Okay, Michael Wayne has a good point, Michael Gable. I mean, looking at the financial space, the beauty of it is it's scalable. So once you've got your core team in place, when you get new funds in through the door, usually, a lot of it just goes to the profit line. So then is it all about size? Do you just choose the biggest companies in this space? What do you think?
Yeah, definitely with those funds management companies, very scalable, but it works both ways, of course. So as soon as they start losing their funds under management when times get tough, then of course you get a big drop in the earnings as well. So I think given the diversity in the sector, it does provide investors with a lot of different options. I mean, when it comes to insurance, never really been a fan of the insurance companies. But coming back to, say, banks and diversified financials, banks, they're obviously very stable. They've got the good dividend at the moment. Diversified financials, you're getting that growth. They might, some, including Macquarie, might seem expensive, but at the moment, it's the company that has the growth and the market is looking for growth and paying for growth. So that's where you're getting your share price appreciation from. But the dividends are starting to catch up as well. So Michael mentioned Magellan Financial. Great result recently, now looking to pay 90 to 95% payout ratio. So at the moment, I think the sweet spot's in diversified financials. When it comes to the big four banks, there's still space there to trade those, and we've been trading those recently. I think what investors will notice is in the last few years, probably at least twice a year, you get this big sell-off in the banks, and that's usually the better time to to buy banking shares.
I mean, Michael comes up with a good point in that, you know, there are different cycles that underlie, I guess, the different subsectors. For example, the big four banks, it's probably the housing sector at the moment, which is a big driver of their potential growth or holding back potential growth. In the insurance space, you've got the tailwind of rising global interest rates. And in diversified financials, well, we're still near all-time record highs with the US stock market, and many of the indices overseas are doing relatively well. So looking at the three subsectors, Michael Wade, which one do you like in terms of the growth outlook?
The growth outlook, I would still stick with the fund managers for now. I still think equity markets are coming towards the end of the bull market, but there's potentially a couple more years in it. Banks have obviously got headwinds with the lack of credit growth, the decline in the housing market that we're starting to see, tighter lending restrictions. So banks are tough. Insurance companies seem to be moving in the right direction in that you've got premiums going up after a number of years of pretty intense competition when it came to premiums. There seems to be evidence that that's waning a little bit, so that's a positive for insurance businesses. You also got interest rates, as you touched on, and bond yields moving higher, so they're making more money on their investment returns. So essentially what insurance companies do is they collect your insurance premiums and then they invest those premiums hoping to earn more on them than they have to repay out, essentially. So insurance companies look like they're doing well at the moment. However, there's always the unknown, which is natural weather disasters and those unforeseeable events.
So favourite stock in this space, what is it?
Favourite stock at the moment is probably Challenger Financial Group, just on a bit of a value play. It's a bit unloved at the moment. Sentiment's pretty negative towards it, but this is a business that's been up around the $14 mark not too long ago. Its result recently was definitely on the softer side of things, but it's undoubtable that the long-term tailwinds still remain, and I think this could potentially be an opportunity to pick up what is a quality business with a good long-term profile.
So Australia's largest seller of annuity products,
That's right.
Challenger Financial. Michael Gable, would you agree, or do you have your own favourite in this space?
Look, Challenger, it's a fantastic business. It's looking interesting down at these levels from a charting perspective. But my pick is almost forgotten it. Magellan. So we spoke about it earlier. Sorry. So good result. Profit was above expectations. The payout ratio, which I mentioned. The average broker target's around that $30 mark. So there's still a little bit of upside compared to valuation. But the way it's trading just looks really bullish. And in my opinion, it looks ready to break out of that recent range from the last few weeks or so and go on a bit of a run. So yeah, quite happy with that one.
It's time for an email now. Let's go to this email from Momtaz. Estia has gone from about $8 to $4. I bought some, sold them at a loss. Today it's down again. Is it catching a falling knife one more time? And can you guess a price on technical or fundamentals? Well, we just heard that there will be a royal commission into the aged care space, and all three of the major aged care providers on the Aussie share market today dropping more than 15% in one day. So is this a buying opportunity, or where do you start to accumulate a stock like Estia? Michael Gable, having a look at the technicals first, what do you think when you see a sharp move like that? Do you stay away? Where are some technical targets?
Yeah, with Estia, I'm fairly certain there's going to be lower levels based on the way this is trading. So I had a look at the chart. I think it'll go back to that previous low, which was 206. I think it closed around 240 today. Potentially another 10% downside. Not necessarily going to happen in the next few days, but over time, due to the uncertainty, because it's only just been announced this weekend of the Royal Commission, we don't know how it will affect Estia, but I just don't think you need to be rushing into the stock just yet.
I mean, it's such an emotive space, and I feel that it will be so much more emotive than the Banking Royal Commission was. So you've got these aged care providers, but you have this demographic trend of more people needing aged care services, and yet it's been such a difficult place to make a profit over the last couple of decades. What's your view?
Yeah, you would think, looking at the very long-term tailwinds, that something like aged care would do quite well, but it's just simply not the case because of a number of factors. I mean, at the moment, Estia Health has quite high occupancy rates. It's not the fact that they've got all this excess capacity. They've filled out their places pretty well. But there are a lot of costs to the business in many ways, and their revenue in some cases is capped by not only government expectations but also community expectations. So often with these sorts of businesses, whether it is aged care facilities, childcare facilities, even things like private health insurance, the expectations of the community aren't necessarily consistent with shareholders or management, in that high margins and poor service or poor quality service isn't really enabled or allowed. So I think these businesses in some ways have variable costs, but in many cases fixed revenue growth, which is a bit of a concern for me. So I'll be steering clear for now.
Any levels that you'd be interested in buying the stock at?
Oh, look, I mean, there's always a price, I suppose, but it's more of someone who's a bit of a bottom feeder. I tend to try and look at things like balance sheet momentum and look at earnings and potential outlook for earnings and margin growth. And I just don't really see that for a business like Estia at the moment. So I'd be very cautious and steering clear, looking at other areas.
Okay, so Michael Wayne cautious and Michael Gable seeing a possible target of around about $2.06 on the stock. So more pain to come, according to our panellists. Let's go to another email, this one from David. Is there a view on Nick Scali, NCK? Is the housing cycle a headwind or is that overstated? Nick Scali's been doing extremely well. I mean, the stock's been performing well with a rollout of more stores, and just having a look at the share price chart over the past year, I guess over the past year it's just been stable, but we've seen recovery from around about that $5.80 mark previously to about $6.48 today. So Michael, looking at Nick Scali, what do you think of the stock?
I wouldn't be rushing into it. The chart does look weak, the way it's been trading. When we had a look at the recent results, like-for-like sales, same-store sales were flat. The owner even mentioned that he thought that margins were probably peaking for the time being, and we have seen the owner sell some shares as well. So a couple of negative signs there, and obviously in terms of housing pulling back, that could have a bit of a negative effect as well. So maybe some of these things are overstated, but you just have to ask yourself, do you really want to be investing in something where there are some headwinds and trying to sort of buck the trend? And at the moment, I think the trend is more to the downside in these stocks.
I mean, the beautiful thing about retail is once you have a winning formula, you can just open up new stores, and that tends to help your revenue line and hopefully profit over time. But having a look at Nick Scali, we know that stock's very difficult to move in terms of housing stock. And for me, it's when I'm move into a new place, that I've got the new sofa, the new bed, the new furniture. What's your view on Nick Scali?
So Nick Scali is one that we've liked in the past, and I've had clients and I've held it myself, but I probably sold probably a year ago around these prices because of the concerns about the housing market. The business itself has continued to perform very well. The rollout store model has been very positive for them so far. Revenues have been growing off the back of that. Margin expansion has been very good, but the question is whether or not that momentum can be maintained. And I do grow a little bit wary of these rollout programs because obviously originally you roll out stores in favourable locations, but the issue is over time, once you sort of pick off a lot of the low-hanging fruit, you start moving into areas that might not be as profitable. So they can't just keep rolling out stores, you would think, forever. And I think at some point the falling housing prices, the weakening housing market will have an effect on them.
Ahead, our stock in a minute, plus this week's buy, hold and sell calls.
You're watching Equity Investor on Sky News Business.
Now it's our stock in a minute with Gaurav Sodhi from Intelligent Investor.
I think IOOF is now...
IFL ticker code.
Yep. IFL, yeah, I think it's now pretty much standout buying. This is a platform fund manager, and you can call it a bit of a trustee financial advisor as well. But the platform business is 50% of the value here, and it's a nice, sticky, capital-light business. And look, they haven't been getting a lot of market share of late. The hubs and the net wealths have been doing more of the heavy lifting in that sector. But this is still a nice business, and the multiples are just too cheap. There's problems here and there are warts on it, but I think you're more than covered by that valuation, and it pays everything out in dividends. So I think that keeps a nice backstop on your potential losses should things not work out as expected. So buy for me.
So that was IOOF with Gaurav Sodhi from InvestSmart. So having a look at IOOF, it's great that they pay out all their profits in terms of dividends, but when you see a stock chart like this, where the stock's down 27% over the past year, I guess the dividends don't provide much of a cushion. But the key question is this value here or is it a value trap? What do you think, Michael Wayne?
To Gaurav's point, look, it is looking a lot cheaper and the dividend yield is very attractive. The thing is, the business has been doing it a little bit tough of late. Margins have been under pressure. Cash flows haven't been that good. And there is question marks over whether that dividend per share will be able to be maintained going forward. There's a lot of competition in that platform space, so Netwealth, Hub24, Premium. There's also been some talk that BT might be cutting the fees on their platform, and that could see a race to the bottom of sorts in that industry, again putting further downward pressure on margins. So I'll be tempted to hold and look for a bit of a base, and probably sort of, wait for it to sort of settle down before looking at it. But I just think looking at that diversified financial space, or that financial space as we touched on earlier in the program, there are better alternatives at this point in time.
Okay, IOOF, I mean, fees are coming down, but that's with, a lot of the diversified financials and the managed fund space as well. What do you think? An opportunity here or falling knife?
I mean, I agree with Michael. He covered it pretty well. In terms of broker targets, so it's trading about 35% under the average broker target. So I guess a lot of analysts out there do believe that it is cheap, but a lot of them have also been reducing their earnings targets for the next year. So I think you've got this sort of reduction in their expectations and a stock that's sliding away with these headwinds. So everyone thinks it's cheap, but the market's not buying it. In terms of the chart, around $8, there's some support. It's a little bit under that now. Maybe it sees a bit of a bounce here, but at the moment, I think the momentum is heading in the wrong direction.
Okay, so there's been a little bit of pain and I guess a bit of divergence in terms of IOOF. Time for my favourite session, and that's buy, hold, sell. Let's start off with Michael Gable. What are you buying?
So I'm going for a sort of a medium-term momentum play here. Santos, I know it's the highest it's been in 3 years, but stocks that go up do make new highs. That's the way it works. So, fantastic looking chart. The momentum's there. Even on today's breakout, I think it's a buy.
And you're holding A2 Milk?
A2 Milk. The result was pretty good. I think we spoke about this before the result. I said, let's just wait for the result. I wasn't too keen on it, but good result. Market liked it. Good commentary from management. Broken a downtrend that started 6 months ago. Good momentum. I think it'll go to a new high.
Okay, let's start off by talking about Michael's buy and holds, which is Santos as well as A2 Milk. Michael Wayne, what do you think of these two companies?
Yeah, Santos, we don't normally invest that much in energy companies or commodity businesses. Santos was a buy for us about a year or so ago. We recently sold it leading into their results just before they had the big jump up, but we did very well off it. We like what this business was doing on a company-specific level, getting their costs down. They reduced things like headcount. They paid off a substantial amount of their debt. And there's also been signs recently that they've started to reinvest in capital expenditure. So it's definitely one of our preferred picks in the energy space, but we're a little bit cautious on the outlook for oil, so that's why we've decided to sell it. A2 Milk is one, again, that I've had clients into for a very long time. They don't hold their original position by any means. We've sold in different tranches along the way and often at lower prices than it is today. But I would be tempted to hold as well. Wouldn't necessarily jump in as a buy just yet. I just think there are still some question marks over its expansion. Okay,
well, putting the spotlight back on you, Michael. What are you buying?
So we're buying Bapcor at the moment. Bapcor is the aftermarket parts business. So it's a wholesale distributor of aftermarket parts. The chances are if you have an accident, need a new car part, your mechanic will get the part from Bapcor. It's trading on relatively cheap multiples of about 22 times earnings. So when you look at the market at the moment, look at some of the very high growth businesses trading on nosebleed multiples. Bapcor looks relatively attractive on a PE growth basis. They've done a very good job of incorporating the recent acquisition of Halaby's, and same-store sales growth is good, margin growth is positive, so it's one that we continue to like despite the fact it's had a decent run. In terms of the hold at the moment, looking at Aristocrat, ALL. Basically, Aristocrat's a very high-quality business, had a very good couple of years. It's been under a little bit of pressure recently. It dipped below $30 briefly. That's despite the fact that the business is about to report in a couple of months. It's doing very well in the casinos business. It's also doing very well in the digital space, which is a very large and yet to be sort of dominated market. So I see ongoing tailwinds for this business, as well as the fact that the falling Australian dollar is another bonus for them.
Okay, so two very interesting stocks. Michael, I know you like cars, so looking at, car parts in terms of Bapcor, what's your view on Bapcor, and what do you think of Aristocrat Leisure in terms of the gaming space? Very much an international company that's been doing well. Share price chart doesn't look too bad, 38%.
Yeah, look, I really like both. I mean, Bapcor, we had it in our newsletter last week. I'm looking for an entry point again, so I think that looks, there's still legs on Bapcor. And Aristocrat, I've traded this a couple of times over the last few years, done really well. Last sold it 6 months ago, a bit early, unfortunately, but it has weakened off recently, and I'm looking to re-enter. I don't recall off the top of my head what those levels are, but it's one on our watch list. So both of them look really good.
So liking the stocks and buying on any weakness and pullbacks.
Definitely, yeah.
The hard part sell, what are you selling, Michael?
Suncorp. So I guess this goes back to, not that we have any to sell, but if I had some, I'd sell Suncorp. So going back to the challenges with the insurance sector, Suncorp obviously had a good run up. The market seemed to like the result, but within a day or two, the selling kicked in, and especially in the last 2 weeks, really savage selling in the stock. So it doesn't look too good from a technical perspective. I think this one will head back. Obviously the market liked, they're selling their life business. They've got a bit of extra return of capital, but I think there's further headwinds and I just wouldn't be in it.
Okay, and obviously reporting season is important because those stocks that do well during reporting season not only are performing better than the market as a group usually 6 weeks after the result, but also 5 months down the track. So that glow lasts for a little while. So smart of Michael Gable to have a look at some of those underperformers in that August reporting season. Michael Wayne, what are you selling?
Cabcharge. So Cabcharge had a bit of strength over the last year, but again, I think it started to come under a little bit of pressure. I still think the macro headwinds are there for Cabcharge with the likes of Uber and all those ride-sharing applications. The thing with Cabcharge as well is there's some regulatory risk. The Victoria, for instance, capped the premium that they could charge to 5%. Some of the other states are looking at doing a similar sort of thing. Cabcharge has also been incentivising a lot of drivers to take up their product, and that's seen driver numbers increase, but it's not going to have much of an impact on margins, or probably a negative impact on margins. So the question is whether or not those drivers will stick once those incentives start to fade out. So for me, I just think that Cabcharge will again come under some pressure.
Okay, and I caught a taxi here tonight, and apparently it was really, really slow. So unfortunately, all those extra drivers and cars on the road may be having an impact on the market. And of course, we have Ola, I think, is the new competitor in terms of the ride-sharing space as well. We hope you've enjoyed the program tonight. A big thanks to my guests, Michael Wayne from Medallion Financial and also Michael Gable from Fairmont Equities. A reminder that you can catch up on the show anytime with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au, and if you're overseas, we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature.